This week on WealthTrack, an exclusive on crisis investing with great investor Hersh Cohen.
Individuals, what Warren Buffett says, you're like a batter with an infinite number of strikes at bat. You don't have 3 strikes and you're out. You can wait. You can be patient. I'm not saying it's easy. Patience, big virtue. Number one virtue you can probably have in the stock market.
Perspective from 50-plus years experience this week on Consuelo Mack WealthTrack.
Funding provided by Morgan Le Fay Dreams Foundation, Clearbridge Investments, a Legg Mason company, Miller Value Funds, Royce & Associates, Matthews Asia, First Eagle Investment Management, and Strategas Asset Management.
Hello and welcome to this edition of WealthTrack. I'm Consuelo Mack. Our topic this week, how to invest through a crisis. We are in a rolling one right now, subject to the vagaries of the advance or retreat of the COVID-19 virus. It is an ever-changing scenario. So far, the markets have been betting on COVID's retreat and global economic recovery. These charts, courtesy of Ed Hyman's team at Evercore ISI, tell that story. Since the March 23rd low, the S&P 500's recovery has been a V-shape, as has Germany's equivalent DAX index and the price of copper, an economically sensitive metal. Contrast those rebounds to these employment declines, courtesy of Jason Trennett's research at Strategas. Total non-farm payrolls fell from 152.5 million in 2019 to 130.3 million at the worst of the shutdown and have recovered to only 137.8 million by recent count. Still nearly 15 million jobs lower than the peak. According to Strategas' calculations, unemployment claims at the worst of the Great Lockdown this year reached 7.1% of the population, far exceeding any period since the Great Depression. How to handle these extremes as investors? Well, as we have so many times in the past, we are calling upon a veteran investor to help us out. He is great investor Hersh Cohen, co-chief investment officer of Clearbridge Investments, where he oversees $150 billion in assets, including the firm's dividend strategy portfolios. With more than 50 years of managing money under his belt, Cohen established his reputation with the Clearbridge Appreciation Fund, which he ran for 3 decades, during which he edged out the S&P 500 with much less risk and volatility than the market. I asked Cohen to put the pandemic experience in context. How does it compare to other crises?
Well, the first word that came to mind when this hit was unprecedented. Unprecedented in terms of the lockdown of an entire country, the lack of knowledge as to how extensive this would be. So 2 comparisons that came to mind. One was 9/11 and the impact on a country, the impact particularly in New York, but on a country as a whole, to the psyche of the country, what it did. I'll come back to that. And then the 2008 financial crisis. And so they're different, but in both cases we had drastic market drops, disruption to the country, just as we have now. Post 9/11, people didn't know when we would get back to normal. I used to think, how's downtown New York ever going to come back? And it actually took years. It took years for people to feel comfortable and to go back down. 20 years later, almost 20 years later, but it happened, and that's encouraging. Although clearly, the number of years were painful. I first wrote something right after the pandemic broke out, a week or so after. I said, well, the good thing is that unlike 2008, when you could blame Wall Street, the bankers, and there would be a big blame game going on, this would not have any politics, because who could have politics over a pandemic? Worst prediction I've made since I don't know when.
We throw up our hands at that, no question about it.
Right. So, but here's the thing. Well, let's go back one more crisis, the 1930, post 1929. I remember my wife asked me after one of the huge down days, a 12% down day in the beginning of this, she said, oh, is this another 1929? Because I said, that's one of the worst days on record. The crash at 29 was 11%.
Just for the record, you were not around in 1929.
I was not around in 1929, but I have certainly.
This is because you're a market historian.
I have certainly put a lot of study into the
Right.
to the 30s, the Great Depression. And I said, well, I don't think this will become a 1930, but that's the real question, because the mistakes that were made in 1930 are being clearly the opposite is happening now. The Fed,
Yes.
The Fed accidentally tightened. You had the Smoot-Hawley tariffs, which shut down world trade. I'm not happy about the rattling of cages again with China. I hope that with the first part of the trade deal that would go away, because I think tariffs would be a dangerous thing in this. I don't like them, period, but in this economy,
Right.
not good. But the Fed has really, they've saved the bacon, so to speak. They stepped in as they did in 2009, and they rang a bell for the stock market. If there's ever such a thing as ringing a bell, in the middle of March of 2009, the Fed came in and said, we're going to buy unlimited quantities of mortgage-backed securities. And that was like ding, 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 because what it said is the Fed is going to stand behind everything. And I think, so the Fed has done that in triplicate and quadruplicate in this particular crisis. This time, there was no delay. The Fed came in with both guns blazing in this in this crisis. And first, it was taking interest rates down to zero. Second, it was backing up the money funds. Third, it was backing up commercial paper. Fourth, it was backing up mortgage-backed securities, collateralized loans, short-term munis. All the things that could by themselves create massive havoc. So you've really had an incredibly strong response to this. And clearly what's happened is what's have become known as the Fed put. In other words, anything that goes wrong, the Federal Reserve comes in and keeps it from collapsing. Is that their intent? I think it probably is part of their intent. And I view it as doing their best to save the world. This is not just a U.S. thing. This is a world phenomenon. You see what Europe just finally agreed on a massive stimulus package. So, and in addition, the government, the House and the
Congress
Senate,
and the White House.
Gosh, they started. They came out with a high-powered stimulus program. So this thing has been really attacked to avoid the worst case. So people have gotten smarter about how to handle this. And so there's wrangling going on right now, but it'll get solved. You don't have a choice. And I think what it has done is keep people from the worst case. It doesn't address the worst of the economic problems in the country. It doesn't address inequality. It doesn't address a lot of things. But what it does is at least it puts a safety net under many people.
So far, so good, as far as that's concerned. But the damage to the economy is real. How do you feel about the fact that the stock market has been incredibly strong, and the economy is still, still very weak, even though it's recovering, but it's recovering from the depths of a shutdown?
The single most asked question I get is, gosh, what's going on with the market? The economy is really stinks. What's going on? And so I think there's and the economy is bad, and I'm not as optimistic about how soon it's going to recover to anywhere near what it was. It'll take ages. I'm worried about the secondary, tertiary fallouts from things. Nobody knows. I think Charlie Munger said at the beginning, how can you know? You can't. This is unprecedented, so how can we know? But the question of how can the market be doing what it's doing in the face of this economy, that's a different story. And the different story is twofold. Number one, the massive amounts of liquidity, the effective zero interest rates. And that liquidity, people say, well, gee, it's amazing. There's no inflation. Well, there is this asset inflation. That's what's happening. This money is not going into the cost of groceries and computers and autos and stuff. And there's sales all over the place on things. It's going into financial assets. And
and also now homes. People are actually buying homes again.
So I read, yeah. So number one, massive amounts of liquidity, very low interest rates, which means you can't really put an adequate price earnings ratio on the market, because if you believe in the old valuation methods, which I do, and you somehow have a relationship between long-term interest rates, the 10-year Treasury, and price earnings ratios, you would say that price earnings ratios could be infinite because you have a zero divisor. Okay, I'm not saying they'll be infinite, but people shouldn't say, oh, price earnings ratios of 30 are out of the question. They might be valid. And the second thing is what I think is equally important in the rise of the stock market, what has come the acronym TINA. There is no alternative. Yes. And I don't consider that a valid reason for making investment decisions, but it is certainly leading to people being forced to buy stock. There is no alternative. And so you think about, I've been saying this for several years, what do pension funds, what do foundations do who need a certain return? We used to get a 60-40 mix, kind of a mix that came to be after interest rates got up into the 8 and 9% in the 70s, and pension funds would have 60% in stocks, 40% in bonds, make a nice return, meet your obligations. Well, what do you do when the 60% of stocks seems high? And although we don't know for sure if it is or it isn't, but it let's say nominally it looks high, but more importantly, you're getting effectively nothing from your fixed income portion. So it puts a stress on a lot of things. So there is no alternative. It's forcing people to buy more stock. For the purpose of individual investors, it's much easier than it is for institutions, for fund managers, for institutional managers.
Why do you say that?
I say that because if you are, and I see it, if you are an institutional investor, a mutual fund manager, someone who's managing money for people whose numbers are being scrutinized every day, and you see the FANG stocks, Facebook, Amazon, Netflix, Microsoft, Apple, if you see them going up every day and you have half the amount of those stocks in the index, you're worried about losing your job.
Right,
so as
because
an
you're not doing well relative to the index.
FOMO, fear of missing out. And so it drives people into these high fly. That's the institutional world. And I don't think I'm exaggerating it. I see it. Even though I don't manage mutual funds anymore, I feel that pressure. However, doing this long enough and I know enough, I don't have to do that. And individuals don't have to. Individuals, what Warren Buffett says, you're like a batter with an infinite number of strikes at bat. You don't have 3 strikes and you're out. You can wait. You can be patient. I'm not saying it's easy. Patience, big virtue. Number one virtue you can probably have in the stock market. So fear of missing out is really a driving a lot of these moves where you're getting stocks that have gone what I'll call parabolic. I'm not talking stocks with nice 45-degree uptrend. I'm talking stocks that uptrend and boom, parabolic. Right. And that's never that never lasts. Something happens, and whatever it is, something happens and it'll break it. But what do you do if you're a fund manager and you're in a performance derby? And the answer is you drive these stocks higher. What should people who want long-term financial success and security do? They should be buying the great companies when the market's down and occasionally making a change. So, I've had to make a few changes over the years. There are stocks that were great dividend raisers, great companies. Mm-hmm. Maybe some in the energy industry where things have changed, and so you have to make a change. But for the most part, the great companies 30 years ago, many of them are still the great companies. Some have fallen by the wayside, so you can't just sit back and do nothing. You watch them, you study, you have to put some work into it, and people make it more complicated than they need to.
But let's talk about those stocks. We've had a couple of our viewers write in and say, you've got to have Hersh Cohen on again. We've been looking at his 2010 interview, which is still available on WealthTrack.com. And, where you were talking about the fact what a great opportunity it was in 2010 to buy some of these wonderful dividend compounders that you're talking about. And the reason that you gave Hersh at the time was that the 10-year Treasury at that time was 3%. It's now at like 0.6%.
Yeah.
And the dividends on some of your dividend compounders, the yield, were over 3%. Well, the dividend yield in the S&P 500 now is like, a little under 2%.
Yeah.
And you call that a great buying opportunity because you had these great companies that were yielding more than the 10-year Treasury. Well, boy, are they ever now. Is this a great buying opportunity?
Well, let me come back to that. I'm going to start by going back to 2003 when they changed the tax law on dividends. Dividends had fallen out of favor in the 1990s. It used to be that dividends accounted for almost half the return of the stock market on a long-term basis because of stock options and kind of corporate greed. I say dividend payouts shrunk to where they were now down to 25% of after-tax profits, down from the 40 and 50% that companies had paid. When they changed the tax laws and made dividends more tax advantaged, Scott Glasser and I came up with the idea of a program devoted to companies that had the ability to raise their dividends on a regular basis. It wasn't a mutual fund; it was separately managed accounts. They still go on. We love it. What we said in 2009, 2010, that for the first time since the mid-1950s, the upfront yield, that is the dividend yield on stocks, was greater than the upfront yield on treasuries. You hadn't seen that in how many years? A little over 50 years, because stocks were considered capital gains vehicles, and you had the great post-World War II bull market, and then So dividends have become very important. And I think now it's clear everyone's getting into the dividend business now because people see it works. It's really a good way. It works. Do I think it was a great opportunity in 2010? Yes. I mean, we made that clear.
What
I
about now?
Do I think it's a great opportunity? I think it's a Tina opportunity. There is no alternative. It's not. I have to say, given the price of the multiples of stocks, it's a little harder to make the case that you pound the glove on stocks in general.
Right.
I think you have to maybe go slowly. But if you ask me, is there an advantage over dividend-paying stocks versus anything else? I come back to that, what other people have come to use as their mantra, which really is a good alternative. But here's what people have to remember. If you don't have the patience to be in there for long periods of time, you shouldn't do it. You shouldn't do it, because if you go in, if you wait for the market to get hot and you wait for it to get heated up and you buy stocks and then you get scared out at the first sign of a pandemic or whatever, that's a scientific way to lose money. And you don't want that. You want, and you know what's incredible? This thing went down 35%. This market went down 35% in what, a few weeks? It got it back. This country is amazing. The Fed does the right thing. Things, it's always worked out, and there's no reason to believe it won't work out in the future. But you have to be patient. It's not. Yes, stocks are really attractive relative to treasuries, but are treasuries, is this a natural level for treasuries?
Right.
I would say for a year or two, yes. After that, if treasuries do start up, who knows? I mean, there's so much uncertainty on them. But listen, I love stocks, and you can certainly, and actually a lot of great dividend payers have been left for dead as some of the tech stocks went up. And so you've had some great opportunities in the last couple of months to add to these great dividend payers, and a lot of them have started to come to life. And I can think of, I don't want to mention
so
individual
give us some
stocks.
examples, because I'm looking at your dividend compounders list, which we'll update and put on our website once again, because again, it's one of the most popular things we've ever had on WealthTrack.
I have to be careful about naming individual stocks in case we're buying them or in the
Right, but just in general, I'm just looking, just so our viewers know, it's like companies like 3M and Coca-Cola and Home Depot and IP and Procter & Gamble and Texas Instruments and Johnson & Johnson. Yeah. All of those companies were on this list.
Yeah, and occasionally one gets dinged. But let me tell you, if you try to cherry pick 3 stocks and then one gets killed, you're in trouble. You really need a package of these. I had to make a presentation to one of my oldest institutional accounts when I did a Zoom call with them, and I wanted to bring them up to date. And I started to go through, because I've told them that dividend investing is clearly what one of the things that we do the best. And I went through all the stocks in their portfolio, and this is incredible. One stock had cut its dividend, Weyerhaeuser. Over 20 of them had already this year raised their dividend in a pretty tough year, including during the past couple of months. So
no, that's incredible, Hersh. I did not know that.
Yeah. Now, the rate of dividend increases is slowing. You had a big catch-up period in 2010, 11, 12, 13 dividends were going up in the above 10% dividend increases on average. Now they've slowed down. Sometimes you're still getting a penny or two, but you're still getting sustainability and even increases. And so I don't know a better way to accumulate long-term wealth than great companies bought right and held for decades, and then make a change. If something goes wrong, make a change. Look, GE was a great company. It became a disaster. And so you take your medicine, you sell GE, hopefully before it goes to single digits, and you switch to something else. But in the meantime, things like Johnson & Johnson, 3M, great utilities. Next year, those have done really well over the years. So you're going to have a turkey. But that's part of investing. That's can't be perfect. I had a client tell me years ago, may he rest in peace. He said, if you don't have tax losses at the end of the year, you're not trying hard enough. In other words, you're not being imaginative enough. It's true. You're going to have losses. Get used to it. I don't like them. Who likes them?
You're known as a chronic warrior. I've been interviewing you many times over the years, and you're always concerned about performance and how your shareholders are doing. So what is worrying you today? What are you most worried about?
I'm going to say two things. One, directly stock market related, because I think we don't have a clue what corporate earnings are going to be next year. I worry about the economy recovering. I worry about how much it will recover. I worry about the estimates of the earnings estimates for next year range from $120 to $170 for the S&P. If you can drive a truck through estimates like that, all it tells you is nobody knows. You're seeing a difficulty in reopening things. The second thing I worry about, people losing jobs, not getting their jobs back, and more broadly, the wealth inequality. And you just would really love to see, more people able to invest. You'd love to see minorities be able to participate in this economy. Do I worry about it? Yeah, I think everybody's always worried about it, but I think the country's had a real wake-up call, and that's a good thing. And we'll figure out, I'm guessing we'll figure out some ways to deal with it.
From your lips to God's ears.
I hope so. I hope so.
I do too. One investment for a long-term diversified portfolio.
An updated list of the dividend payers. Great companies bought right, and not just one, a package of them. And there are many ways to do that. You can pick them off one by one yourself. There are funds, and that's the way I see it. So I've done both.
And that's worked over the many years I've been interviewing you. It's been a really good portfolio suggestion. So Hersh Cohen, always a treat to talk to you, and thank you so much for your perspective and your optimism. Makes me feel a lot better.
Oh, I didn't know I was being optimistic, but that's nice. Consuelo, I love you. I'm so glad to be on with you, and thank you. And everybody stay healthy.
Thanks, Hersh. At the conclusion of every Wealth Track, we try to give you one suggestion to help you build and protect your wealth over the long term. This week's action point is don't try to time the market. Strategas' Jason Trennert reminded me of the dangers of market timing in a recent report. Here are the numbers for the S&P 500's compounded annual growth rate between 1995 and June of 2020. 7.8% annualized returns if you stayed fully invested. That drops to 5.9% if you miss just the 5 best trading days. Miss the 20 best market days, your annual return falls to 2.4%. Miss the 30 best, you barely break even on an annual basis. The best 40 days lost, it's negative 1%. Unless the best 50 trading days, your returns are down to minus 2.5%. That's how hard market timing is. Better to stay invested in the market at your comfort level, of course. Next week, another great value investor tackles economic inequality. Gotham Asset Management's Joel Greenblatt shares his common sense investor's guide to equality, opportunity, and growth. In this week's extra feature, Hersh Cohen will discuss how COVID-19 has permanently altered his outlook and behavior. He will also share his very popular dividend compounders list on WealthTrack.com. As always, thank you for connecting with us on Facebook, Twitter, and our YouTube channel. Thanks for spending time with us. Enjoy your weekend and make the week ahead a healthy, profitable, and productive one.